podcast where we put you on the map. This is Ron Costa broadcasting live from the Mappable US Studios in Las Vegas, Nevada. And folks, we're going to be talking a little bit about multifamily today. It's going to be a great conversation. Grab a cup of coffee and get ready to do that. But before we do, let's introduce Vicki Hutchmala from the QLZ Marketplace. Vicki, how are you doing today?
I'm fabulous today, Ron. You know, I say this every time we do a podcast, what the weather's like in Vegas, but you know what? This is our time, our Vegas time. This is why we live here. This is why we endure the summers, because we're into perfect weather now. Everything is beautiful, great day, great podcast. One of our very, very favoriteest guests is on. We're going to talk about real estate, opportunity zones, mostly multifamily, and I can't wait. So let's get started.
Let's do it for sure. And let's introduce one of our favorites, Neal Bawa. He's the CEO of MultifamilyU. Neal, how are you doing today?
Fantastic. Great to be on the podcast again.
Yeah, we love having you on. We've done a number with you before, and they always get great ratings. We get a lot of people saying, you know, where'd you find that guy? And he's ours. So that's it. But, you know, and out there, you know, I know, Neal, you do a lot of webinars. You've got a lot of things going on. So before we get into the whole topic of multifamily, can we get a little background on you and how you got to be where you are and what your company's doing?
Sure. So I'm a technologist, you know, a geek, a nerd, whatever you want to call it. You know, computer science degree, data science background. And I got into real estate in reverse because I live in California, and I was basically, you know, had the big fast tech job, and I wasn't keeping a lot of my money. I was making it and then giving it to the man, and sort of backed my way into real estate over a very long time, a decade, from 2003 to 2013. You know, learned real estate just primarily as a tax benefit, and then started to see all of the other long-term, wealth benefits of real estate. And after 10 years, decided maybe I should make this my career. So started that in 2014. Currently have about 1,000 investors that have invested $300 million with us. And we've used their money to buy and build all kinds of different assets, multifamily and build to rent being the two largest categories, but we've also invested in a number of different asset classes.
Right.
Yeah,
and the last time we had you on, I think we were talking about build to rent. If people that listen to that podcast, which I hope they did, they did quite well, because that is a trend that is continuing right now. We're seeing it here in Vegas as well. But you're mostly involved in multifamily investments, right, with your syndication group?
Pretty much. So we buy and build apartments. So we have altogether our assets are in 16 markets in 10 states. So multifamily apartments, you know, we also build them. So we built apartments, we built student housing, we built flex industrial and office space. We've also bought and improved storage facilities. But the core, you're right, continues to be multifamily. Maybe about half of our assets are in multifamily.
Okay, that's great.
Well, I'm sorry, Ron. I was just going to ask Neal, since he's focusing on multifamily and that over the last few years since we first met him, how do you think multifamily has changed, and for the better or for the worse?
I think it's changed
in the last few years,
and in a more humbling way. So people like me and let's say another 10,000 of my brethren in the industry known as syndication or multifamily syndication, I think are all have less hubris, have less ego, have less, there's been a little bit of a deflation in that marketplace, and some of the things that people have said, including myself, have not turned out to be true. And that reduction in hubris, that reduction in, multifamily can only ever go up, because of there being, a severe shortage of housing, some of those things have become more nuanced. So now where people 2 or 3 years ago might have said, not me in this instance, but other people have said, multifamily can only ever go up because our housing shortage is getting worse. And now people say, multifamily can only ever go up in the long run. In the short run, interest rates can impact the prices of multifamily. So I like that because, as a data scientist, I want to be very specific and very clear in what I say. I want to have a bunch of caveats and asterisks that are attached to my statements so that I'm as clear as can be. And unfortunately, our industry hasn't necessarily been that way. And now I'm beginning to see that. I'm beginning to see, prices of multifamily come down. They've come down about somewhere between 15 and 25%. There's a few markets where they've come down even more than 25%. And on top of that, they've also, the expectations of rent growth have moderated. People were putting in 3%, 4%, 5% into their pro forma. Now I'm seeing more 2%. Some people are even doing 1% rent growth. So I think overall the industry over the last 2 years, this impact of interest rates has led to the multifamily syndication industry, not the overall multifamily industry, but the syndication part, which is the part that we've been hearing a lot about, has started to mature. We also might lose some syndicators because some of their properties might go back to the bank, and that means that they are likely to lose a number of their investors. And, a lot of these folks, they were doing syndication. They were technologists or doctors, and they were doing syndication on the side. And I think a number of them will go back to their day jobs. So bottom line is that for the industry, this is a period of a little bit of humble crow. It's a period of, maturation where people are maturing. They're learning more about what they said, which may or may not have turned out to be true in the last 2 years. And it's also a time when there's very significant opportunity looking forward compared to 24 months ago. So compared to 24 months ago, there is vastly more opportunity in multifamily today, but we can talk about that separately.
Well, I've observed that in regard with real estate, with that industry, whether it's multifamily, whether it's just regular commercial, residential, it's appears to be that everything is relative within the industry. So interest rates can impact this, and mortgage rates, and availability and opportunity zones, and all of these things are relative to each other. And if one thing kind of falls off the rail, it impacts everything else. And so in my mind, it's very important to be really 360 degrees strategic so that you can be prepared for potential situations where you have to adapt. Because if you can't adapt to what's going on in the world around you, since everything is relative, you're never going to be successful in whatever you do. And I don't know, do you find that that's more with real estate than other industries, or is that just general across the board?
I think it's general across the board. But I think the point that you're making is you really have to be nimble in real estate right now. Why nimble? Because before, everything just worked. Everything worked. Prices only went in one direction, and they were, and rents only went in one direction. And that's really, if you look at the story of the last 6 or 7 years, maybe 8 years before mid-2022. So go back 7 years, 8 years from mid-2022, and you'll notice that prices only went up and rents only went up, except for a short 1 quarter decline during COVID. And so what that did was it created a sense of complacency. You didn't need Vicky Hashmala's 360-degree view to survive and thrive during that time. But today you do. Right. You have to be extremely careful about what you're doing. You have to basically hedge your bets more, right? You need more insurance. You need more operating budgets. You need a lot more. You need to be better as a buyer, better as a builder, and you need to be better as a operator of multifamily than you did, let's say, 24 to 36 months ago. And that is good news. It's good news for everybody. The people that were good now need to be better, and the people that were bad are simply not going to be in business.
Yeah,
Right,
it reminds me of that line a couple of years ago, Neal, when prices were soaring everywhere, and they said, well, all you got to do is throw a dart at a map, buy the land, and you're going to make money out of it. And people thought they were geniuses about it. So you're right. Now they have to be a little bit more smart in what they're doing.
Yeah.
But it sounds to me from this conversation so far that you think we're going to be looking at a couple of down years in multifamily and in commercial real estate in general. Is that a right take?
I believe so, and I think that it's not necessarily a bad thing. I think it's a great thing in terms of opportunity. So when I was on your podcast in 2022, and they're all recorded so people can go back, one of the things that I was cautioning was that the prices are too high. I mean, basically the assumptions being made are too aggressive. I've said this a number of times, and on many podcasts, and I've definitely said it on yours, and that was maybe late 21, early 2022 when I was talking about it. And, I've been wrong on many things, but I did turn out to be right on that one. Back in those days, I had students. I used to teach multifamily before COVID. I don't teach it anymore. When I used to teach it, I used to have students, and they came, many of them were new to the multifamily industry. And I watched my students buy 10 properties in a single year. And I would go,
oh my God.
Wait a minute, this is a very, very expensive time. And I have to say, unfortunately, because they weren't listening to some of the things that I was saying, they were drinking the Kool-Aid. There was a huge amount of money available. 3, 4, 5 of those 10 properties are now underwater because those properties either had no rate caps or they probably had rate caps, but those rate caps were expensive. And so, or those rate caps were for a short duration. So they bought a rate cap for a year. So just for those who don't know, a rate cap is something you buy separately from a mortgage, from a separate company. And it basically caps your interest rate. So you have a floating interest rate, and as rates go up, your floating interest rate goes up. So let's say you buy a rate cap at 6%. When you bought the property, maybe the rate was 4. Well, it can rise all the way to 6, but if it goes beyond 6, the difference between 6 and your mortgage is actually paid out by the rate cap company. But if you buy a rate cap that's very high, or if you buy a rate cap that's very short, let's say a year or 2 years, then you can get in trouble. So at this point, we have somewhere between 2,500 and 3,000 properties in the United States, an average of, let's say, 200 units. So we're talking about 60,000 units. These properties are probably worth, and this is my best guess, about $75 billion. Well, these properties are bleeding, meaning they are, forget about paying the investors or paying cash flow. Each month, you have to put more money into these properties just to pay the mortgage. And so the vast majority of these properties were purchased in late 2020, all of 2021, and all of 2022. So during that time, the prices that were paid were fairly outrageous. I was lucky. I bought back one of my own properties, and then I purchased a single property at a pretty high price in a military town, which nobody wanted to touch. My argument back then was, well, if you're going to overpay everywhere else, I might as well get a cheap deal in a military town and deal with the fact that my occupancy is going to go up and down. And I've been pretty happy with that decision. At least I bought it at a much lower price than other people were. But other than that, I didn't buy any buildings. I just waited and watched because it didn't seem real. It didn't seem like this was the right kind of map. And we're now seeing that. So to go back to what Ron said, am I saying that there's going to be distress in multifamily in 2024? Yes, I think so, because there's 3,000 properties. And I think the vast majority of those 3,000, they have to go back to the bank or they have to be sold at lower prices than they were purchased at. So I'm going to define distress. Is it like 2008? No, absolutely not. I don't think that this is anywhere close to that. Keep in mind that if every single one of these properties was sold for $0, which is, I'm joking, that's $75 billion. That's at risk, right?
Yeah.
Where in 2008 we had $8,000 billion at risk. The total size of the distress in the real estate market in 2008 was around $8 trillion. Now, obviously, not all of that stuff, eventually ended up on the courthouse, footsteps. A lot of stuff got resolved over time, which is great. And I expect a lot of the multifamily stuff that I'm talking about to get resolved over time. So, but even if the worst case happens and every single one of these 3,000 properties is sold for, for a very small amount of money, that is still not contagion. In 2008, we had something known as contagion, where prices were affecting other prices, which were affecting other prices, which were affecting other prices. This isn't the impact here because the multifamily industry is very large. It's 20 million units. If every property is 200 units, well, that's 100,000 properties, right? Well, out of that, 3,000 properties are at severe risk of going back. That's about 3%. So distress, yes. Problems, yes. Investor money at risk, yes. Contagion that spreads either to larger parts of the economy or to the rest of multifamily, no.
Yeah, and you're right. That's the big difference. But you said something that was interesting, Neal. It's like when you're aware, when you have the right knowledge for what it is that you're doing, then you're able to recognize the opportunity. So even if the cost of real estate is elevated for whatever reason, then now you're going to have all the potential of foreclosures and returns to the bank and the bank holding properties that they don't want. But now here's the opportunity for the sophisticated investor to get the property on a foreclosure, to pay less for it because it's distressed only in the paperwork, not in the actual location. So now you've, through something that wasn't very good, created an opportunity, but if you don't have the knowledge and the adaptability, you lose out altogether. You can't see it.
You do, though. Yes, though I have to caution you, I don't think that a massive percentage of these 3,000 properties are going to go into, courthouse-style foreclosure. And that happened because in 2008, because courthouse-style foreclosures were the only way to get rid of millions of single-family homes, right? Here we're talking about 3,000 units. So in most cases, the bank is likely to force a sale, meaning, okay, we know you're going to lose all of your money on this, but we need you to sell this property. So what really is likely to happen is that a bunch of these 3,000 properties are likely to come to market this in the next 12 months at discounted prices. So the big opportunity in multifamily simply is we're getting 15 to 25% discounts. We expect those discounts to accelerate to about 30%. And when I say discount, I mean discount from peak, and the peak was March 2022. So it was about 19 months ago. So from that peak, we could get as much as a 30% discount. Now, some people are like, yeah, but the interest rates are high. Well, I'll address interest rates, but here's what I want to say to you. If you were buying a Taco Bell in 2022 versus 2023, and its income was $100,000 and you were buying it for $1 million, today, if its income is $100,000 and you're buying it for $800,000, 20% less, why wouldn't you buy that Taco Bell, right? You pay a multiple of income. My point is that today, the price decline that we have seen, that 15 to 25% price decline, has nothing to do with the property's income. It just has to do with financing costs. If the income has remained the same and you're paying 15 to 25% less, well, that is the right kind of opportunity. That's the Warren Buffett opportunity. You're buying something when it's cheap, right? Because its income has not been affected. In fact, rents have gone up over the last 18 months. They aren't going up strongly. They're slow, gradual rent growth because we had some incredible rent growth in late 2021, early 2022. So it slowed drastically. But if you look at the last 18 months, overall rents are up. When rents go up, income usually goes up. Even though expenses and insurance are going up, it's likely that if you look at 10,000 or 100,000 properties in the U.S. and compare their income today to what it was 18 months ago, you'll see that there's an uptick in general, if you average them out. So you're in a situation where the industry itself is doing well. Occupancy is close to 95%, so 94 point whatever, 94.6, 94.7, which by historical levels is excellent. People have a good amount of money. Unemployment's under 4%. But you're still getting a 15 to 25% discount on an asset. And you're only getting it because interest rates are high. And I tell people this, Vicky, if you believe that interest rates, whether you're buying single family or multifamily, right? If you believe that these interest rates will be the same 18 to 24 months from now, you shouldn't buy anything in real estate at all.
Exactly.
No sense, right?
No.
It is my belief that is counterproductive. When you're saying that, you're probably also the same person that was just buying everything in sight in early 2022, not paying any attention to the fact that things were overpriced, right? So you believed in the hype of 2022, and now you're believing in the hype of 2023. The hype of 2023 is interest rates will never go down. The hype of 2022 was multifamily and single family will never go down. Both of those were hype. These are not, statements that are scientific in nature. They're not statements that are prudent. So when people today say interest rates will not go down, they're basically saying the same thing as real estate will always go up. Neither one of these statements has any basis in truth. The Federal Reserve itself, which is the only body in the United States that controls interest rates, is clearly publishing a document called a dot plot. They update it every time they meet. And the dot plot clearly shows interest rates going down in 2024 and 2025. Please Google Federal Reserve dot plot.
Okay, yeah, we'll do that. And we've been talking about interest rates a lot, Neal. But what about inflation? What's inflation's role in this?
So we're doing this in November, 2023, December 2023 timeframe. And I can tell you this, the last thing that people should be worrying about today is inflation. What you should have been doing is worrying about inflation when inflation started rising, which was a Q4 of 2021, and it continued to rise in early 2022, and the Federal Reserve was very, very slow to act, right? They said inflation is transitory. Well, turned out they were extremely wrong, and they ate humble crow. What I like about the Fed is even when they're wrong, they accept their fault. They're not like our politicians who are never wrong. The Fed said we were wrong, and now we have to raise rates much quicker because we were wrong. So that's what I like about the Fed. No one expects the Fed to be rock stars or scientists. If you're that smart, you're probably not working in the government, right? But they course corrected. They raised rates. Today, why has the Fed not raised rates in the last meeting? What about the meeting before? What about the meeting before that? They're holding rates because they believe that they've done enough, and they want to see more evidence that they've done enough before they can say we're going to start lowering rates. So anyone and everyone should have been worrying about inflation since Q4 of 2021, even before the Fed was worrying about it. And you should have been worrying about inflation until about 4 or 5 months ago. If you go back and look at, there's many different ways of inflation. There's one called, many different types of inflation. There's something known as core inflation, something known as PCE inflation. There's even other forms of inflation that the Federal Reserve uses, and you can find those on the web by Googling what measures of inflation does the Federal Reserve track. By all measures of inflation that the Federal Reserve tracks, inflation is A, down, and B, continuing to decline, right? It's a little bumpy because that's the nature of our economy. You can, see brief upticks in inflation in certain areas, but overall, it's down. Also, employment numbers are down. The United States was at one point producing 500,000 jobs in a month, then 400, then 300, then 200, now about 150,000 jobs a month. Because one of the key ways to reduce inflation is to reduce employment. When you reduce employment, less people are employed, well, demand comes down. So my question is, once again, if you're data-driven, why weren't you worried about inflation at the end of 2021? And if you're data-driven, then why are you worried about inflation today? The Federal Reserve beat the economy into a pulp to reduce inflation, and they were successful. And by the way, the Fed has always been successful. They have raised interest rates 9 times since World War II, and they have killed inflation 9 times. Now, I do want to point out that in the 1980s, they stopped too soon, and inflation went back up. So they had to do it twice. Now, because of that, and because Jerome Powell uses that mistake in the 1980s in his examples, that's why the Fed's waiting. Why hasn't the Fed cut interest rates when inflation is down? The answer is they don't want it to go back up. So they're sitting there and waiting. And a lot of people are like, yeah, but that means inflation could go back up. No. Imagine what the Fed has done in the last 12 months. As a 500-pound weight, actually I'm going to call it 550 pounds because it's 5.5%. Basically, imagine a 550-pound weight that the Fed has placed on the chest of the economy. And obviously, that brings the economy to its knees. Now, the Fed isn't adding any more weight. They started with 100 pounds. Then they went to 200 pounds, 300, 500. Today, they're at 550. But that weight of 550 pounds is still on the chest of the economy. And the economy is still on its knees, right? So by doing nothing, the Fed is still putting a tremendous amount of downward pressure on the economy because the 550 pounds are still there.
Right. Yeah. Well, I know myself, I've been affected greatly on inflation whenever I step on the scale and weigh myself. That's a scary thing.
That's right. Yeah, that was Diwali yesterday, so let's not talk about weight.
But it goes back to the initial observation that this is why you have to be aware of the relativity of everything going on so that you are able to deal with it, able to recognize it, able to take advantage of it when you can, but also allow the economy to kind of fix itself without too much involvement from artificial sources like the Fed or like the bank rates or like, all of the potentials. It still comes down to be aware, be knowledgeable, know what you're doing so you can recognize when things are bad and good and do what needs to be done. Be educated. That's what we try to do.
Yeah, and I want to give you an example of how relative things are. Let me finish this thought. Multifamily, 15 to 25% reduction. Other asset classes like office, even greater reductions. Single family in the last 12 months, up 1.8%. So the single family market has seen interest rates go from 24 months ago from 3.02 to 7.5. So the mortgages have more than doubled, so 2.5 times, which means that the interest portion of your mortgage payment is now 2.5 times. But what happens to single family homes? They go up 1.8%. In the same time frame that multifamilies are down 15 to 25%. It's all relative. Not everything behaves the same way. There are different factors at play in every different part of the real estate market, right? So today, I'm in awe of the incredible strength of the single-family market, the fact that it hasn't crashed. There are a million YouTube videos that you can find in the last 12 months, all predicting the doom in the single-family market when rates even go up to 5%. Today, they're at 7.5%, and we are seeing the market do great, right? And it's not going up gangbusters. In fact, my forecast is it will probably go down 5, 6, 7%. It should go down 5, 6, 7%. A little bit of steam coming out of the single-family market. It's not a bad thing. It's a good thing. It's a normalization thing, right? Just like it has happened for multifamily, there should be a lot of steam being taken out. But I'm in awe of just how well the single-family market has performed, and it shows just how strong the desire for people is to continue buying single-family homes, even when mortgages are 2.5 times more expensive.
Well, and rent, I don't know about other cities, but in Vegas, if you can't get a mortgage to buy a house, a single-family house, and you have to now go into looking to rent, the rents in Vegas are outrageous for what you get. You got a 600 square foot studio apartment that may be brand new, but you're paying $1,500 a month in rent for it. It's like, what? That's crazy. And you have to factor that part in too.
That's where the opportunity is. The gap between the starter home mortgage, the monthly mortgage payment on a starter home, the cheapest home you can find, and the equivalent rent is the highest in history in the last 12 months. So today it's $1,030. It briefly was over $1,100. But on average, looking at the entire country, that gap is over $1,000. Historically, even in the craziest part of the 2006 boom, that number never went up above $750. So today, it just doesn't make sense to buy. The people that are buying are the ones that want to buy and are able to buy. But everyone that just does not have the income to buy, because remember, the higher this gap, the more difficult it is to qualify, right? Because you need about 3x the income to qualify. So if you're getting a $500,000 mortgage and it's at 8%, that's $40,000. Add in insurance, add in the principal. Now you need to have income 3 times whatever that number is. And what we've done is in the last 3 years, since COVID started, the average increase in salaries needed to buy that starter home in the United States, the average increase in 3.5 years, 88%. So your salary needed to be 88% higher than the day before COVID. It needs to be 88% higher today to buy that same starter home. And in 3.5 years, people's salaries have only gone up about 15%. And that means that we have now marooned about 8 to 12 million middle-class families who never will buy. They are forever renters. And that's the market that I'm addressing. I feel like it's a tragedy. I feel like, oh my God, the government should be doing something about this. But I'm not in politics. My job is to make money for my investors. And I'm saying to them, today the market has calmed down. This is good because values make more sense. And today there's discounts available. Right?
Great, Neal. Hey, before we end this podcast, I do have one last question. Based on what you just said, what's the status of the new construction in multifamily at that point? Are there new projects being built right now? What are you seeing on that?
There's a slowdown because construction costs have gone up a lot in the last 3 years. Interest rates have gone up and loan-to-values have gone down, plus multifamily values are dropping. So we are seeing a reduction in new construction. I would say perhaps 30% down, perhaps 40% down. There aren't exact numbers that are easily available. And that doesn't mean anything for incoming supply today, because today's incoming supply was, they started working on it back in 2021. But when you slow down multifamily by 30% today, then you're going to have a supply gap. You're going to have a supply hole in 2025 or 2026. So when investors tell me, when do you think the multifamily market could boom again? My answer is 2026, because we are right now digging a supply hole with reduced apartment construction. And that means that in 2026, rents could go up significantly in that time frame. So, I don't expect that to happen in 2024 because interest rates are still going to be high in 2024.
Okay, excellent. Now, so in other words, now if somebody just calls you out of the blue and says, Neal Bawa, I want to get into the market somehow. What do you tell them? They want to invest in your projects, or what's your what do you tell a prospective investor on this? Should you sit back? Should you go forward?
I tell them I didn't buy much in 2022 or 2021. They can look at the data purchase of my properties, and today I'm in a greedy mode, right? I follow Warren Buffett. He says, be careful when others are greedy. Be greedy when others are careful, right? So, fearful. Sorry. So today everyone's fearful because of what they're seeing in the marketplace, and I'm greedy. So I'm buying properties. I'm not building a lot of properties right now. I've actually paused a bunch of my projects, but I am buying as much land as I can because land today is extraordinarily cheap.
Interesting.
Extraordinarily cheap.
I'm wondering if you
is that around the country?
No,
land being
quite
cheap.
Good. So I would say some of the most boom markets, you're seeing land prices down 40%. In some of the other markets, you might not see the price even down by 40%, but the terms have changed. In 2022, you had 120 days to close on land. Now you can easily negotiate 18 months. So you're not buying it for 18 months, but you're working on it.
Okay. Well, now, last thing, Neal, is if somebody's listening to this podcast and wants more information, wants to get a hold of you somehow, what's the best way to do that?
The best way really is to engage with us, to learn more about what we do, and that is at multifamilyU.com. So multifamily followed by the letter U.com. We do webinars there, 12 webinars a year. About 25,000 people attend those webinars. Vicky actually attends all of our webinars, so I see her all the time. And, I'm not sure about Ron, but I know Vicky does. And, that's the right way to engage and to learn about our data, right? It's a fascinating process. We talk about lots of interesting things. We talk about things beyond real estate. We talk about oil. We talk about, what's happening in the capital markets, what's happening to banks. So it's a lot of very interesting, fun information presented in an engaging fashion. And we spend about 30 seconds in each of those presentations telling you about our projects. And so at that point, if any of those projects looks interesting, you can join us. Otherwise, just tune out for those 30 seconds and go back into the webinar when we continue forward. That's the right way. So multifamilyU.com.
Yeah,
and you have one coming up on Thursday.
That's right. Yep. Have a webinar coming up.
Yeah, I mentioned on the last podcast that we did with you, I'm like addicted to your little location magic thing. I think that's one of your best ones. And I have the whole Excel spreadsheet. It's like so much fun. It's like people look at me like, "What are you doing?"
Nice.
It's really great information. Anybody, that's one I would really recommend to everybody out there to attend. And honestly, you look at the name of it, Multifamily University. This is a college education. I mean, if you really want to go to school for real estate, I don't even think you can do that, right? I mean, other than a real estate, there's little schools here and there. But I see a lot of real estate agents working for Starbucks these days, Neal. So
that's right.
I guess they should have listened. They should have attended a webinar.
Maybe they should have paid attention to our webinars. But it's a lot of very thought-provoking information, and it's very highly actionable. We provide very specific action items that you can do and can engage in. And so join us at multifamilyU.com. You'll learn a lot of interesting things. There's no subscription. There's no upsell. You cannot buy the education. There's no fees. We'll never charge you for a recorded event. They're always free. But, our education is always meant to be free. And Ron and Vicky have been coming for years, and they know this. We've been publishing education on the web for about a decade now.
Because that's better. All right, Vicky, before we close this out, do you have any last questions or comments for Neal?
Well, what I'd like to say, Ron, is the reason we love Neal and love him as a guest on our podcast is because he has information that's valuable. And if you are interested in the real estate industry and the market, Neal is your absolute source for that knowledge because he will teach you what you need to know to be successful in whatever it is that you're doing. Use Neal as a resource because he will help you be successful. That's why we love you so much, Neal, because you're so special.
Thank you so much. I truly appreciate what you said. Thank you.
Yes, and we appreciate you, Neal. Thanks so much for taking time out and being a guest on the show. Vicky, thanks for co-hosting this episode. And folks, you're listening to the Mappable USA podcast at MappableUSA.com. Just go to our website, scroll down. You'll see all our syndication sources. Just pick the one you like best and subscribe, and you'll never miss another one of our podcasts. If you want to be a guest on the show like Neal was today, there's a guest tab there. Fill that out. We'll see what you can do about getting you on the show. And if you like what you heard, send us an email at info@MappableUSA.com. or just leave a comment on whatever page you're listening to this on right now. So thanks for listening. Thanks for your support. We'll see you next time on another Mappable USA podcast. Have a great week, everyone.
Thank you.